Hey guys, I hope you and your families are doing well. In this video, I'd like to share with you 6 areas of swing trading I think are very important to focus on. Number 1 is the type of stocks that you're looking to swing trade. Number 2 is understanding market breadth, overbought and oversold readings on key indicators. Number 3, as you can see on your screen now, is understanding the 4 phases of the price cycle: phase 1 accumulation, phase 2 uptrend, phase 3 distributional top, phase 4 downtrend, and then that leads us into the final 3 parts, which are the type of setups that you are targeting, how you are controlling the risk, and then the selling rules and guidelines that you are following to optimize profits, both in terms of monetary gain but efficiency of the monetary gain as well. Before we get into it, I'll let you know that Market Surge are today's video sponsor. If you're interested in a discounted trial, then there is a link in the comment section and the description below. So part number 1 is going to be the type of stocks that I look to swing trade. I'm going to show you 2 Market Surge charts, one being Nvidia and then the next being precious metal miner HMY. This part is going to focus on the fundamentals I hold in highest regard, whereas part number 4, when we get into the type of setups, is going to discuss the technical action that I look for. So we're going to then marry the two together, the fundamentals with the technicals. So the William O'Neill Can Slim criteria that he taught you in his book How to Make Money in Stocks, which is an absolute must read I think for swing traders, has a significant influence and had a significant influence on the type of stocks that I'm looking to target. So let's start here with Nvidia and let me give you the highlight reel. In essence, I'm looking for a company that has huge earnings, huge sales, after tax margins accelerating, EPS annual estimates going into all-time high territory, forward guidance being raised. Ideally, it's involved in a new revolutionary technology such as artificial intelligence. There is institutional support and institutional liquidity. That's really it from a fundamental perspective that I'm focusing on. So let's start breaking that down. Let's start with the earnings side of things. So if we take a look at Nvidia, over the last 3 quarters, it's reporting triple-digit earnings. 429%, these are year-over-year numbers on a quarterly basis. 429%, 593%, 486%. So if you look at that, what Nvidia has just done in its most recently reported quarter is it reported $5.16 in earnings versus 88 cents from the year previously. So looking at things on a quarterly basis removes the seasonality effect. So it's apples and apples, oranges and oranges. So 500, it's not 500, it would be even better if it was 500, $5.16 versus 88 cents is a mega rate of change on a year-over-year basis, especially for a company of this size. So triple-digit earnings are really good to see, especially if the company has a global product, which Nvidia does. If we then take a look at the sales, it's the same thing that I like to see. I like to see huge sales coming through. Triple digits are fantastic. So if we look at the last 3 quarters for Nvidia, it's 101%, 206%, 265%. So on a quarterly basis, the most recently reported quarter, Nvidia reported $22.1 billion in quarterly sales versus from the same time a year previously, $6 billion. So sales on a quarterly basis have gone from $6 billion to $22 billion in the space of 12 months. Think about that. That is mega in terms of rate of change. I can't recall any other publicly traded company going from $6 billion to $22 billion in quarterly sales in the space of 12 months. Staggering. Then we take a look at the margins. So what do we see with the margins? Well, the margins have been accelerating too. So the after-tax margins, something else I focus on. So increase of 37%, 49%, 55%, 58%. So the trend line there is up. So we have earnings on a year-over-year basis accelerating in triple digits. We have the same for sales. We have acceleration in terms of the after-tax margins, something that institutions love. So I'm really trying to dial in. This is the point of the William O'Neill Can Slim criteria. What are the stocks? And usually there's only a handful of them. What are the stocks that the institutions must own? Like they must own. These are the key ones that they need to get involved in. And we'll talk about kind of the technical action a little bit later on. But if you take a look here, this is the annual EPS. I think this is really important. It's a little nuanced, but this is something I like to see. Sequential growth. So like we like to see, try and say that 10 times quickly, like we like to see sequential growth in terms of the quarterly earnings, the quarterly sales, the acceleration in the after-tax margins. It's great if the annual earnings per share is also doing that. So if you see the uptick here, $1, $1, $1, $2, $4, $3, and then here's the kicker, $12, $23, $28, mega rate of change. So not only are the annual EPS estimates going into all-time high territory by some margin, they've also got the forward guidance being raised. That's what this little green up arrow means there. Forward guidance has also been raised. So then we start piecing this together. Okay, you understand a little bit about the company as well. You can obviously see the relative strength line, all-time, no, it's a little bit off all-time highs right now. about 17% off all-time highs, but a company of 52-week highs, all-time highs. We're talking a little bit about the technicals there, but if we take a look at the EPS annual growth, if we take a look at the estimates, we take a look at the earnings, take a look at the sales, take a look at the acceleration in the after-tax margins, we can see numerous higher quality growth funds. I may be covering a little bit the numerous higher quality growth funds in there as well. We can see, you can just work out the dollar volume of the stock. It's absolutely mega. I think it's around about 20 billion or something like that. But the institutional liquidity there as well. So the daily dollar volume is also going to be really important. I like to focus on stocks that have an average daily dollar volume of greater than 50 million, but ideally greater than 100 million, because that's where the institutions can more so move easily in and out of it. Hundreds of millions over a billion, even better, such as Nvidia. So these are going to be some of the key fundamentals that I'm looking for. But what we can also do, and we'll talk about this in terms of the technicals when we get into part 4, is understanding themes, understanding emergence of relative strength. So right now at the time of filming, precious metal miners are a strong area. So then what I'm trying to do is dial in and try and find the leaders. Now there's certain technical things that I'm looking for to see that's going to be at relative strength. There's a stock near all-time high, 52-week highs, but keeping it on the type of stocks and more so fundamentals, it's the same exercise here with Harmony Gold mining. So what I'm looking for is big earnings coming through. So we can see here, if you take a look at the earnings, the last 3 quarters, 74%, 205%, 205%, there's my stutter, 205%. Really good to see. Now the sales aren't as good in terms of triple digits like we saw with, say, Nvidia, 6%, 26%, 26%. There is some acceleration in the after-tax margins going from 12% to 18% to 18%. Obviously the RS line is very good, but these are then things that I like to look for. So what we can see is the estimates now for the annual EPS, so earnings per share is EPS, going into all-time high territory over the last 8 years. I really like that. Okay, so like I like to see a stock going into all-time high territory or very close to it, it's the same with the annual EPS. If it's near all-time high territory or going into all-time high territory and forward guidance has been raised and the estimates are up significantly, then I give that significant weight. So just a highlight reel in terms of what I like to look for there, if I go back to Nvidia, is really big earnings, really big sales, acceleration in the after-tax margins, annual EPS increasing sequentially, the estimates going into all-time high territory, forward guidance being raised, institutional sponsorship, institutional liquidity. Those are the key things that I am really looking for when I'm looking at the fundamentals of a stock. So now we'll go into part 2, which is going to be market breadth. So part number 2 is going to be market breadth. So understanding oversold conditions and overbought conditions, which I like to think about as the market tide comes in and the market tide goes out, and the market will just mean revert. That tide will flow in, that tide will flow out, and hopefully this analogy really helps you when we're looking at a couple of things here, because there's some complexity involved, because you're going to have to look at multiple charts and see correlations. So what we've got on the top is we've got the NASDAQ comp. The ticker for that is IXIC. What we've got on the bottom chart is the NASDAQ comp stocks above their 50-day moving average. NCFI is the ticker if you want to find it on TradingView. I'll put some other useful tickers up as well. 20-day breadth readings, 50-day breadth readings, and also 200-day breadth readings as well. You'll have to add these levels manually. Okay, this is an indicator. I've added these levels manually. So what are these levels? Well, we have 75, which is going to be a percentage. So these levels here are a percentage, 75%, 25%. And you'll see at the time of filming, the reading is currently less than 25%. So that is oversold. That is the tide going out. And you're going to see the market mean reverts. The tide goes out, the tide comes in. The tide goes out, the tide goes in. So what does that reading down here mean, which is around about 20%? Well, it means only 20% of stocks in the NASDAQ comp, and there's circa 3,000 of them, are above their 50-day moving average. If the reading is up here above 75%, that means greater than 75% of stocks, whatever the reading is, in the NASDAQ comp are above their 50-day. So that's overbought territory. So we think about overbought territory as the tide is in. So if I do up here, okay, this is in, and then this is, excuse my bad handwriting, this is out. So the market tide goes in, goes out, goes in, goes out, goes in, goes out, goes in, goes out, goes in, goes out. So this is a really important concept, okay? So this is how the market moves. This is how breadth moves. The tide flows in, the tide flows out. The tide flows in, the tide flows out. And you can start to see some of the correlations. So when you're up here, and it's important to then think across different durations. So I'm going to add a little bit of a complexity here, so try and stay with me. What you have is you have different breadth readings. You can look at the NASDAQ comp 20-day, 50-day, and 200-day. You could do that for the S&P 500. You could do that for the NASDAQ 100 as well. So you have a 20-day breadth tide, you have a 50-day breadth tide, and then you have a 200-day breadth tide. So you've got to be aware of tides in different durations. So the 20-day tide, because it's closer to the price action, is going to flow in and out quicker relative to the 50-day tide and then the 200-day tide. So this is all about understanding the tide of the market, and it's important for you as a swing trader in your strategy. You're probably going to be more so focused on the long side, is you've got to know when is it likely to be a harder time? When is that tide going out against me? Psychologically, I think it's really important to know about this, okay? Because if you've just been trading over the last 6 weeks or so, maybe a little bit longer, as that market tide is flowing out, so the 50-day reading is going from overbought, so the tide is in, to then flowing to oversold, the tide is going out, it's probably been harder. Conversely, late last year into Jan, kind of Feb time, this period in time here, was probably better if you were swing trading on the long side, was it not? So now you can start to see how the tide affected it. So here, the tide is going in, you're swimming with the tide. Here, the tide is going out, you're swimming against the tide, you're starting to see it. But we get tides on different durations. 20-day, 50-day, and 200-day are the ones that I focus on. So you just want to be aware of this. When you start getting overbought, so up here, there's greater than 75% of stocks in the NASDAQ comp above their 50-day. You can see where the index is. And then you can see what happened. The market tide flowed out. You can then see here as well, okay? Over 75% of stocks in the NASDAQ comp were above their 50-day, okay? The tide is now in. So this is about, Livermore spoke about it just really eloquently in his book in terms of reminiscences of a stock operator, understanding where the next swing is. Okay, what is the next swing in the market? So I use breadth to do this, because for me, the market is just going to mean revert. So what it's going to do, you can see up here as well, okay? You can see the correlations of when the tide is in. Well, the tide is in. It's not going to come in much further, is it? Like it's already in, it's already there. However, when the tide starts getting out, like this, okay, the next swing, even when it looks terrible, okay, go and think back, what were you thinking here? When the market had sliced through its 200-day, which is the red line there, sliced through its 200-day looked terrible, but from a breadth standpoint, you're here. And this is how quickly the market can turn. And then the tide comes back in, and then the tide flows back out. That's just the way the market ebbs and flows. So the 50-day readings, so that's going to be NCFI for the NASDAQ comp, it's going to be NDFI for the NASDAQ 100, and S5FI for the S&P 500, are just useful to check once a week or so, maybe a couple times a week, to just go, okay, where is the market tide? Do I think I'm swimming with the tide? Do I think I'm swimming against the tide? And where do I think the next kind of swing of importance is going to be? When it's oversold down here, this is where you're going to get a lot of bearish articles, a lot of bearish financial media. When it's in here, this is where you're going to get a lot of positive. Okay? Narrative follows price. People's narrative follows the price. But oftentimes people do the wrong thing at the wrong time. People will be really, really bearish here. People will be really, really bearish here, won't they? You probably were as well. Really, really bearish here. Oh, it's lost the 200-day. It's going to go back down. Not so fast. Okay, not so fast. So this here is useful. So let me now show you another chart, which I also think is useful. We're going to look at weekly timeframes. So we've now got 3 weekly charts. We've got the triple Qs on the top on the weekly chart. The black line is going to be the 10-week SMA. The red line is going to be the 40-week SMA. On the daily chart, that's closely aligned with the 50-day and the 200-day simple period moving average. In the middle on the weekly chart, we've got the NDFI, which is the NASDAQ 100 stocks above their 50-day moving average. And then on the bottom, we've got the McLennan oscillator and my version of it on TradingView. So if you click indicators here, it's going to be this one here, the McLennan oscillator, Jack Corsellis one, that one there. It's useful, okay? So if we look on the weekly chart for the McLennan oscillator, you're going to get oversold readings and you're going to get overbought readings, and I put the levels on there for you. So oversold is going to be 75. These aren't percentages, this is minus 75, and overbought is going to be positive 40, so plus 40. But specifically, I'm going to focus on these oversold levels. So as I said, this market breadth, we're going to add a little bit of complexity to this, okay? You've got to realize different correlations in the market, and there may be some confusing signs at times as well, such as negative divergences, positive divergences. But if we take a look here, okay, this McLennan oscillator on the weekly chart, okay, it gives you a slightly different reading on the weekly to the daily, but weekly oversold readings on the McLennan oscillator do not happen that often. On average, they happen about once per year. Sometimes you can go a whole year without an oversold reading, such as 2021, such as 2017. So when you get an oversold reading on the McLennan oscillator on a weekly chart, it doesn't happen that often. Maybe on average around about once per year. So you can see the correlations, right? If we just look here, I'll just mark some of them up. Okay, if we just look at some of the correlations in here, you have it in here as well. Okay, you have it in 2019 as well. You obviously had it at the lows of 2020. So it doesn't mean that McLaren oscillator oversold, everything's going to turn around on a dime. It didn't happen like that. Okay, if you use that tide analogy, I just think it's useful. Because if you've ever seen the tide go in and the tide go out, it doesn't happen like a click of the fingers, does it? It takes time, but you're understanding where the next movement is likely to be. Okay, we can see a lot of oversold readings here, so that means the tide is out quite far. Now, the tide isn't just going to come rushing back in 5 minutes, it's going to slowly come back in. And then when we are overbought, that is, the tide is in. So up at these levels here, okay, when you're up here, when you're up here, when you're up here, this is more so the tide is in, and the next swing is probably going to be the market tide going out. So these are just important things to be focusing on. Okay, you can see the last oversold reading, like really oversold, was here and also here. So is it useful to kind of think about the correlations of these things? Yeah, it is. But it's also then common sense to go, the market tide is not going to come rushing back in 5 minutes later, 10 minutes later. The market just doesn't move like that. You've got to have kind of a feeling and understanding how the market does move. So then if you line up your McLaren oscillator oversold readings with, say, the 50-day breadth reading for the NASDAQ 100 on the weekly chart, you can see the correlation, right? And you can see when are you most likely to be finding it more difficult, finding it challenging, be frustrated, be just angry, annoyed at yourself, at the market, at other people. Well, it's probably going to be as the market is transitioning, as that tide is flowing out. Okay, so tide is in. So remember, this is in. Okay, this is out. So as that market tide is flowing out, that's probably when you're going to be most annoyed. But just at your peak, so if we then kind of think about this a little bit more as well, if you think about when are you most exuberant, when are you most happy? Well, you're probably most happy around these times, around these times, around these times, around these times. If you've been trading for longer than 2 weeks, and I'm using that obviously hypothetically, if you've been in this game a little while, you will know and you will experience that when you start getting those good feelings, you know, when you start getting those good feelings, you want to be telling your friends, telling your spouse and things like that about trading really well. You should see this. You should see this. Is that usually quite close to a top in your experience? So it's interesting, right? There's a lot of market operators within the market, many, many millions of them, but oftentimes it feels like it is just you and the market knows where you are when you are there. Okay, so when you start having those feelings of, yeah, doing well here, trading well, yeah, things are looking good, I want to tell people about it, I want to do this, top's not too far away. That kind of peaks with your equity line, doesn't it? And then on the other side of that coin, when is usually the bottom? What emotions are you feeling? So we just said about the emotions that you're feeling towards the top. And it's funny, quite canny how that kind of works. But then if you also think about your emotions, here, what were your emotions in Q3 heading into Q4 of 2022? What were your emotions here? That was probably when you were at peak levels of frustration, annoyed, thinking about giving up, thinking about doing other things, thinking about doing this or that, frustrated with other people, frustrated with yourself, frustrated with the market, angry at the market, angry at yourself, angry at other people, maybe a bit snappy towards other people as well. But look where we were in terms of breadth. So your emotions, and this is why I think Livermore spent a great deal talking about emotions. Your emotions are kind of usual emotions, and I'm no Buddhist monk, but I can usually tell by my emotions that we are probably near a market top and we are probably near a market bottom based upon how I'm feeling. So then what I try and do is I then flip those emotions on their head, that actually when I am feeling really frustrated and the market looks absolutely terrible and breadth is down here and the McLaren oscillator is down here in terms of these oversold readings, that's not usually too far away from a market bottom. And the other side of the coin, so then I try and get excited, try and dial in, try and stay focused. Okay, what are the type of stocks that I'm looking to target here? Where are the leaders? Where's the relative strength? Can I get positioned with myself? Why? Because I think then the next swing of importance is going to be that market tide coming back in. And this is just how the market moves. This is how it ebbs and flows. So when I am feeling exuberant and I'm feeling happy, I'm feeling excited, things are going well, I've also got to be aware, flip that other side of the coin. Okay, a market top could be short-term, long-term, is probably in terms of the length of the pullback. Maybe it's just kind of a month pullback. Maybe it's something a little bit more severe. We never know, one day at a time. But when I start getting those feelings, I've got to be aware of that and go, okay, I tend to experience these feelings when things are going well, which tends to signal there could be a market top nearby. So I've got to be vigilant. I've got to be aware. I've got to follow my selling rules. Okay, because sometimes if you've been in a stock and it's done really well, it's then very difficult to sell it. Okay, like, I'll hold it. This one's a really good one. This one's a really good one. And then, oopsie daisy, right? Oopsie daisy, as my 2-year-old would say. See what I mean? So it's really important to think about this breadth. So I know I spent a long time on this. This is, I think, probably the most important part of the video, actually, which is why I want to spend some time on this one with you, is to think about breadth as a tide and realize that the tide flows in, the tide flows out, and then also understand your emotions at different point during the tide. Understand what your emotions are likely to be when the tide has gone out, and understand what your emotions are likely to be like when the tide has gone in. And just kind of be aware of that, accept that, and go, okay, this is probably how I'm going to feel, but is how I'm feeling going to affect my trading plan, going to affect what I'm trying to do from an identification standpoint, from a controlling risk standpoint, from a risk mitigation standpoint, from an optimizing profit standpoint. So that there is then your selling rules and guidelines that you're using. When you are feeling exuberant and you've got a big winner, are you not going to follow your selling rules and guidelines because of how you're feeling? Do you see what I'm trying to say there? So hopefully this section has been useful for you. Now what we're going to do is we're going to go into the third part, which is understanding the 4 phases of the price cycle. So we're now into the third part of this video, which is the 4 phases of the price cycle. So Richard Wyckoff came up with this concept over 100 years ago, and this is who I learnt it from. So those 4 phases are phase 1, accumulation, phase 2, uptrend, phase 3, distributional top, and then a phase 4 downtrend, and the cycle repeats. Now you'll see this, I think, with all financial instruments. Why? Because large operators will accumulate a position, then they'll distribute a position. They'll accumulate a position, they'll distribute a position. Now Warren Buffett's quote of "be fearful when others are greedy and greedy when others are fearful" sums up the mentality of large operators perfectly. So when are a lot of people greedy? Remember, we were just talking about the breadth. Do you see how it's all relating to each other and the interrelatedness between things? So when we are talking about the breadth and being overbought, that is when people are greedy. What was Warren Buffett saying? Be fearful when others are greedy, which is going to be phase 3 distributional tops. And then be greedy when others are fearful. When are you likely to be fearful? Well, it's probably when breadth has now gone oversold. That is probably when you're fearful. So what do you think large operators are doing? They're taking advantage of your fears. Large operators are taking advantage of your emotions, of what you are doing. When you are greedy, they are fearful. They are selling to you. When you are fearful, they are greedy. They are buying off you. See the game? So the game is really trying to understand what the institutions are doing and where is a stock, where is the financial instrument in respect to its own price cycle. There are phase 1 accumulation bases, phase 2 uptrends, phase 3 distributional tops, and there are phase 4 downtrends. And there are repeatable characteristics within each of these phases. And then you can also overlay breadth that we were just doing with that. So you can then get a feel that, okay, phase 1 accumulation bases for many stocks are likely to occur when breadth is in oversold. So say if you're trading US stocks, when the NASDAQ 100, S&P 500, and the NASDAQ comp are in oversold territory. That is where you'll see a lot of phase 1 bases. As breadth is transitioning from oversold to overbought, what are you expecting to see? Well, it's probably going to be some phase 2 uptrends as what? As the tide is flowing back in. And then when we get into overbought territory, the tide is now in. Where do we think the next swing of importance is going to be? Well, if the market is going to mean revert, if the tide does what the tide does, the tide is probably going to flow out. So that's probably where we're going to see a lot of phase 3 distributional tops. And then phase 4 downtrends come through. As breadth transitions from overbought to oversold. The tide was in, the tide is going to go out. And then when you're fearful and panicking down here during phase 4 downtrends, and institutions, large operators, see enough liquidity and perceived value, the 2 things they require above everything else, what do you think they're going to start doing? You got it, phase 1, start accumulating their positions. So as we play through this, okay, I just want to show you a couple of charts here, okay? This is the Dow Jones weekly chart. Now I wasn't alive, I wasn't trading in 1903, 1907, and I doubt you were either. But what do you notice? Phase 1, phase 2, phase 3, phase 4. As the famous book says, there is nothing new under the sun. There's a little more said. Okay, this is the Dow Jones from 1915 to 1925. What do you notice? The market goes up, sideways, down, up, sideways, down. And it just ebbs and flows. There's an ebb and flow to the market. There is a tidal nature to the market and to stocks. If I can show you. This is Keck's weekly chart. Have been a leader, and they're not a leader. You can see that with the RS line 52-week highs, 52-week lows. What do you notice? Well, the stock goes up, the stock goes sideways, and stocks in the market, financial instruments, they only move in one of 2 ways, guys. They move in a trending environment, which is either trending up or trending down, or they move in a non-trending environment, which is going sideways. So, go sideways, phase 1, phase 2, phase 3, phase 4. Show you a couple of others. AMD, back in the 1980s. Coca-Cola, where do you want to own Coca-Cola? So if you're swing trading, and this is how, what I've tried to do here is take this video for a logical flow. Okay, so by the end, you're like, Now I understand why he explained it in that way. And then it's the Bruce Lee quote. Absorb what is useful, reject what is useless, and add what is essentially your own. If you found things useful, great, think about using them. If you didn't find anything useful, you didn't find parts useful, don't use it, reject it. I'm not going to take any offense. And then add what is essentially your own. This is where your own detailed study comes in. And you start to discover things. And you're like, interesting. So let me ask you a question here. We've got Coca-Cola loaded up, covering 13 years from 1991 to 2004. If you were going to be long Coca-Cola, where do you want to be long Coca-Cola? Probably here. Why? Why do you want to be long Coca-Cola then? You're starting to see it. So you want to be aware. Well, you're probably like, well, here. But then, okay, think about that in terms of the price cycle. Phase 2 uptrend. Relative strength. 52-week highs. We'll come on to relative strength when we start talking about the type of setups. Start seeing how it all flows together. If you want to be long Coca-Cola, you probably don't want to be long Coca-Cola here. Why not? Well, it's in a phase 3 top, phase 4 downtrend, and there's a lot of characteristics we would associate with distribution. Widespread candlesticks to the downside, 52-week lows on the relative strength line, pops in volume when you get these widespread candlesticks to the downside. That is repeatable characteristics I would associate with distribution. This is what institutional accumulation looks like and leadership looks like, the 52-week highs. This is what institutions distributing their position phase 3 tops looks like. Let me show you a couple more recent ones, okay? Let me go to, say, Zoom, right? So you're familiar with Zoom, you probably use Zoom, right? So if you look at Zoom, okay, this is basically covering from 2020 to 2022. You can just see the price cycle. Phase 1, phase 2, phase 3, phase 4. And I don't want to spend a lot of time on this because I could spend 5 hours, 10 hours, 20 hours talking about this, about common characteristics that you see in phase 1, phase 2, phase 3, phase 4. And trying to deduce where do you think the stock is? I think it's a leader, not a leader. Peloton. Phase 1, phase 2, phase 3, phase 4. When you see this bar here, which is also on earnings, this bar here, call this bearish synchronicity. Widespread candlestick, open on the low, open on the high, close on the low, pop in the volume, 52-week high, slicing through the moving averages, clearly in a downtrend. Lower low, lower high, lower low, lower high. What do you think institutions are doing? This is what institutional accumulation looks like. This is what institutional distribution looks like. Where is the stock? Fastly as well. Phase 1, phase 2, phase 3. Note the increase in price volatility and the proliferation of large red bars that I just call bearish synchronicity. There is a synchronicity between the negative price action and the large relative volume. Look at the deterioration in the relative strength. DocuSign. Phase 1, phase 2, phase 3, phase 4. Maybe phase 1. Neo. Phase 1, phase 2, phase 3, phase 4. NVIDIA, phase 1, phase 2, phase 3, phase 4. ARK, probably know about ARK, Cathie Wood. Phase 1, phase 2, reaccumulation base, phase 1, phase 2, this is on the monthly chart. Phase 3, phase 4, where do you want to be long ARK? Foot Locker, monthly chart, 1974 to 1998. Phase 1, phase 2, phase 3, phase 4. It's timeless. It's absolutely timeless. ExxonMobil, monthly chart, phase 1, phase 2, phase 3, phase 4. Didn't just happen with US stocks. This is a UK stock that was a leader. Those of you in the UK will be probably familiar with this stock. This is Boohoo Group. Phase 1, phase 2, phase 3, phase 4. And this is about training your pattern recognition. What do you associate institution accumulation looks like? On the other side of that coin, what do you associate institution distribution looks like? For me, this is what institutional accumulation, absorption of supply, and a leading stock looks like. Look at the 52-week highs on the relative strength line. This is what institution distribution looks like. Okay, just bearish synchronicity, the opposite of what was happening here. 52-week lows, increase in volume, widespread, clearly, lower lows, lower highs, trending below the monthly 10 EMA. If you want to be long Boohoo, where do you want to be long Boohoo? Asos, another UK stock. Phase 2, phase 3, phase 4. So you saw this chart at the beginning. This is now making more sense to you. And then this is going to flow us into the next 3 sections, which will cover kind of all in one, type of setups, controlling risk, and optimizing profits. So if you are now aware, and hopefully you've made it this far in the video, well done if you have, and thank you very much for watching my videos. If you've now made it this far, is it all starting to make a little bit more sense? Okay, we're understanding, first and foremost, the type of stocks. What are the stocks in leading areas that the institutions must own, and because of their size that they are trading as well, they are forced to own. Okay, they also have to go where the liquidity is. So you've got to know the type of stocks. What are the type of stocks the institutions are really accumulating and are in? And there are repeatable characteristics, I think, of institutions accumulating positions, absorbing supply. And then there are repeatable characteristics when institutions start distributing their positions. It's quite common sense when you think about it. Institutions are going to accumulate positions, they are going to distribute positions. And because of the size that they trade, visually you're going to see that on the chart. You're not going to see the actions of a retail trader. You kind of can in specific areas, but that's not the point that I'm making. But the point that I'm making is you're going to see it. You're going to see it around the earnings. You're going to see it in terms of the price and volume, how the stock is trending. Is it respecting moving averages? Is it not? Is it making higher highs, higher lows? Is it trending? Is it basing as you would expect it to do in that context of the price cycle? Then if you start seeing widespread volatile behavior getting smashed on the earnings, lower lows, when it makes a new high, it just gets sold into aggressively. Gap, fade, huge volume coming through on it, big gap downs. And then lower lows, lower highs, trending below certain moving averages. That's more so what you would associate with institutions starting to distribute their positions. So then when you start to be aware of this and you go, okay, there's type of stocks that I want to look to trade. I need to understand breadth. I need to understand the market tide. It flows in, it flows out. It flows in, it flows out. It's just what the market does. You can't be angry at the market. If you go and stand next to an estuary and you see the tide flow in, you see the tide flow out, are you annoyed at it? Of course not. That's just what the tide does. It's just what it does. This is what the market does. So you just need to be aware of it. And then aware of the price cycle. That stocks, financial instruments will exhibit across all time frames. More so I'm focused on weekly charts, daily charts. They will exhibit this price cycle. Phase 1 accumulation, phase 2 uptrends, phase 3 distributional tops, phase 4 downtrends. And this coincides, and there is correlation with where is the market from a breadth standpoint. When you are in overbought territory for the NASDAQ 100, S&P 500, and the NASDAQ comp, that is more so when you are going to see a lot of phase 3 distributional tops. Now you may get some pockets of strength that you see phase 3 distributional tops across a wide area of groups and themes, but there may be some pockets of strength. It may be, okay, software, semis, growth is falling out of bed, but precious metal miners, commodity stocks look like they're just coming out of phase 1 basis. And it could be vice versa. So institutions will accumulate positions, they will distribute positions. So then when you're aware of this, that then leads into the type of setups that you're trading. And you can only develop this from a detailed study, your own study. Go back and study. Look. How does a stock move from point A to point B? What do you notice? What do you notice when you now start thinking through the lens and the framework of the 4 phases of the price cycle? What do you tend to notice in a phase 1 accumulation base? What do you tend to notice in a phase 2 uptrend? What do you tend to notice when the uptrend ends and institutions start distributing in a phase 3 distributional top? Are there any common characteristics that you notice? As a stock enters a phase 4 downtrend, are there any common characteristics that you notice, which you tend to see happen? So this is then how you start building your setups and the type of setups. So for me, these are the areas, okay, these green circles are where I look to target setups. Here. Because I think it's repeatable. I can identify these setups time and time and time again. Doesn't mean I'm going to be right all the time. I can control the risk in terms of what I think is creating asymmetric reversible trades because of my expectation of what happens next. And then around this as well, because it is so deliberate in terms of where I'm looking to target these stocks, and having spent countless tens and tens of thousands of hours studying millions and millions of charts, how a stock then moves from point A, being here, from point A to point B. So this is where you'll hear me talk about the 4 areas. Number 1, identify what you deem as a high quality setup. Number 2, control the risk, create an asymmetric reversible trading opportunity. Number 3, mitigate the risk, free roll the trade. Sun Tzu art of war principle, position yourself beyond the possibility of defeat. I would add, as soon as prudently possible. And then number 4 is optimize profits. So what does that mean? It means if you are targeting setups here, okay, so if you're aware that, okay, I'm looking for stocks coming out of phase 1 accumulation basis, coming out of phase 2 uptrends, continuation type basis, flags, pennants, wedges, Darvis boxes, VCPs, cup and handles, ascending triangles, symmetrical, all of that stuff, right? If you're specifically targeting stocks there, you have an idea because of your detailed study that you've done of, well, how does it then trend higher from that continuation type base and how does it top out? So in terms of the optimizing profits, these are selling rules and selling guidelines that you are using for yourself to optimize profits in terms of monetary gain, but efficiency of the monetary gain. See how you start creating your process, but your process is grounded in reality of what actually happens. Not what some analyst gives a price like that, it's going to go to $200. Okay, thanks for coming out. That's not useful. Okay, what do you see with your own eyes? So I'm now going to combine, as I show you some charts, part 4, part 5, and part 6, which is the type of setups, controlling the risk, and then selling rules and selling guidelines that you then use from these setups to optimize profits, both in terms of monetary gain, but efficiency of the monetary gain. So I'm just going to flow through some charts here. I'm going to show you what I call trigger bars, what I call shakeout demand tails, and what I call gap down reversal bars that are covered in a lot of other videos on the channel. You can go look at the blueprint video, and there's loads of other videos on the channel, okay? So this is then what I'm looking to do. Well, I'm looking for stocks in the context of coming out of phase 1 bases, in the context of phase 2 uptrends, where I am seeing characteristics that I would associate with accumulation and optimal setups, both in terms of the repeatable nature of it, that I can just identify it time and time and time again. I can control the risk to create an asymmetric risk versus reward trading opportunity. And then specifically, what am I expecting the stock to do after this entry? Because I'm a trader, I'm going to sell it at some point, right? So if I'm targeting AMD here, so it's moving through the high, or it's Oracle moving through the high, this tight little bar where you get 52-week high in the context of a base, an extreme sign of strength, or pins when I'm targeting pins here, post-earnings reaction, okay? I'm expecting pins to do certain things. Okay, this feeds into my story of the stock, okay? This is how I'm now expecting the stock to play out in terms of trending higher from this phase 2 continuation base. Okay, what am I looking to do here? Okay, how am I looking to enter it? How am I looking to control the risk? How am I looking to free roll the trade? How am I then looking to optimize the profits? What are the selling rules, selling guidelines that I'm going to use for this stock? Now that is based on history, but it's also based on a stock's character as well. But how does this stock move? And then I can go and I can look over 100 years ago, 120 years ago, Dow Jones, weekly chart, trigger bar, coming out of this VCP ascending triangle. Nothing's changed. Dow Jones, another ascending triangle. 1 contraction, 2 contraction, 3 contraction, 4, trigger bar. Nothing's changed. You go hit Bethlehem Steel on the weekly chart. This here is a trigger bar. Tight, nearly an inside week. Tight, low volume, inside week. We go here as well. Zenith. I think Davis was trading this one back in the 50s. This is the 10 week, this red line here. Do you see these tight little bars? Look at this tight little bar here. Look how the volume tries out. It's the same thing. Trigger bars in the right context are just saying there's hardly any selling. There's hardly any supply, which is what I want to see if I'm then targeting a trigger bar in the context of a continuation type base. So these things, this is from the, as I said at the start of this video, William O'Neill, How to Make Money in Stocks book. Brilliant book. First 100 pages are charts like this. So go and look at those 100 charts in the book. It is a must-read book. Go look at them, study them, and go, okay, wow, that's interesting. How did that stock move from $12 to $100? What did it do? What are the repeatable characteristics? Is there anything that you notice? Look at the 10 week. Do certain things happen around there with big winning stocks, as O'Neill calls them? There's one here, American Chain and Cable, 1930s. See this inside week? See the tightness here? It's the same thing, just keeps happening. So then you can start really understanding. So this is a really useful exercise for you to then do. Go back, really study a stock. How does it move from point A to point B? If a stock goes up 50%, 100%, 500%, 1,000%, how does it do it? Look across different time frames as well. If you're a swing trader, look at the weekly chart, look at the monthly chart, look at the daily chart. As it was coming out of a continuation type base, what did you see? What do you see on a consistent basis? What are the common characteristics you see? Do you tend to see tightness in price? Do you see volume dry up? Do you tend to see 52-week highs on the relative strength? Do you see that pre-base, in the base, post-base? And then it's about using that information when you're scanning for and looking for future setups. So then your kind of scanning routine is not haphazard, it's not random. You are looking for specific things. So you are screening for specific things. Okay, so the same thing just keeps happening time and time again. So if I now take you on to shakeout demand tails, and you can do multiple time frame analysis, you want to go even further down the Alice in Wonderland rabbit hole. Okay, as you're looking at, say, like a trigger bar on the daily chart, drop it down onto the 1 hour chart. What do you see? Do you see common characteristics? Nothing random. If you are primarily trading off the weekly chart, or before the stock comes out of a weekly base, maybe it's like a Davis box or something like that, or a flag on the weekly chart, and it's pulled into the 10-week simple period moving average, drop it down onto the daily chart. Are there common characteristics you tend to see before the stock breaks out of that weekly base. It's a useful exercise to do. So let's now go into, let me just find it, there we go, shakeout demand tails. So these are variations of shakeout demand tails. Here's some of the data on them. It's covered in the blueprint video on the channel. These are the type of entries, but oftentimes with trigger bars, shakeout demand tails, and gap down reverse bars, the breakout point is often not the entry point for those three type of candlesticks. It's often not right here where it's just breaking out of the high of the base. Oftentimes it's lower in the base. You'll see that if you go and study them. So Broadcom, okay, shakeout demand tail around one or more key moving averages. So I'm then looking for signs that institutions are in there, nice powerful uptrend, and then certain things to happen around certain moving averages. And it's important as well, so this Broadcom, where I was then targeting it through here and buying it here, okay, after the shakeout demand tail on the 21 day and the volume dried up, but it's really important to also develop a Bayesian mentality. I think both in trading and life, I think it's useful. So what I try and do myself is you just update your decision-making process as new information becomes available. So Broadcom, 6 sessions before I was buying it, loses the 21 over here. Here it's not looking too good. Okay, kind of tightening up here, but here, it's not meeting my setup criteria. I'm not losing any sleep over that. It's not meeting my setup criteria. Maybe it will in a week. I don't know. Just move on. Like, there's no point wasting any mental energy on something that then doesn't meet your setup criteria. You can't force something that's not there. So by you really knowing, okay, what am I trying to do? Like, if I was to ask you, how do you identify a high quality setup? That's where I was targeting a firm. Cancel the order stupidly because it gapped. But if I was to ask you, how do you identify a high quality setup? What are you going to tell me? Look on Twitter, look on bulletin boards, have a chat with my mate at the pub. Is that how you identify a high quality setup? Think that's good? Then if I was to ask you, so here's shakeout demand tails, Dow Jones, shakeout, 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 nearly 100 years ago. So if I was to then ask you, well, okay, if that's the type of setup that you're targeting, how do you control the risk? What do you do? It should be really, really clear. How do you control the risk? How much risk are you looking to take? Do you think about the initial stop loss percentage relative to the ADR percentage? Do you have a max kind of cutoff point for how large your initial stop loss could be? How do you think about risk in terms of an individual trade, but also in terms of your total account equity? Do you use fixed fractional position sizing? Do you risk 0.5%? Do you risk 0.5%? Do you risk 1%? Does it vary? And if it does vary, what does it vary upon? Why are you doing what you're doing when you're doing it? Then if I was to ask you, okay, how do you go about optimizing profits? Sorry, how do you go about mitigating risk? Do you mitigate risk? Do you not mitigate risk? If you do mitigate risk, why do you mitigate risk? How do you mitigate risk? Where do you sell? When do you sell? How much do you sell? Is it dependent? Does it vary upon certain things? If it does, why? Why are you doing that? You should know the answers to this. If I then ask you the fourth part of the question of, okay, let's say S here, it's coming out of a phase 1 base, shakeout demand tail off the 10, low relative volume. So if the stock is then going to move from $18 to $27, and not a single close thus far below the 10 day, then did, what are you doing to optimize the profits? Are you just selling it day 1, day 2? Why? Have you studied history? It's a question, right? Eli Lilly, are you just selling it day 1 because that is a supply issue? Are you just selling it here because you're like, that's a dojo on high volume and just selling? Okay. So how are you optimizing the profits? So if you really think about it, okay, every single trader, every single market operator, whether they know it or not, is working through those 4 questions. They are identifying setups. They may do it very badly, but they are doing it. Some people do it very well, some people do it very badly. Every market operator is making the decision to control risk or not control risk. That's the next stage, okay? This is the setup. How are you controlling risk? Some use a stop loss, some don't use a stop loss. Some do use a stop loss, but they put it at like 15%. Some others use a stop loss and may put it at like 2.5%. Well, why? And then they have the option, once they're in the trade, and the trade starts moving, to mitigate the risk. Do they mitigate the risk? Do they not mitigate the risk? If they do mitigate the risk, how do they mitigate the risk? And then what everyone is then doing is they are optimizing profits some way. Some people do it very well, some people do it very badly. Okay, if you are optimizing profits, and everyone is, what are you doing? In essence, what are your selling rules? What are your selling guidelines to Optimize profits. Do you have any? So you're still optimizing profits. Even if you don't have any, you are still optimizing profits. But you're doing it in a very random and haphazard way, and not an optimal way. If you're going to do something, do it in an optimal way. That's how my brain works. Do it to the best of your ability. That's going to gap down reverse bars. So these are the 5 common candlestick patterns that you'll see. So again, what I did is everything is based in research. Thomas Wolfowski's book, Encyclopedia of Candlestick Charts, gives you all the data. So I know with a belt hold bullish, in his database, he tested 14,542 belt hold bullishes, and the reversal rate is 71%. I know the performance, I know the frequency rank. Bullish engulfing candlestick, there's 20,000 database inputs. I know the bull market reversal rate is 63%. So it's then, well, can I find a belt hold bullish? Well, the belt hold bullish is in a leading stock, so we started with the type of stocks. Nvidia's HMY, currently a leader in terms of precious metal miner from a fundamental perspective. Technically looks pretty strong as well. So what if I can identify a belt hold bullish, which is a gap down reversal bar, but it also coincides off the 21 moving average, EMA, off the 50-day SMA. You should know what you're doing, why you are doing it. So a gap down reversal bars, again, study them. Okay, like here we're talking, this is a belt hold bullish and also a bullish engulfing candlestick, and even better that it actually opens on the low of the bar, engulfs the prior bar, and it's on the 21 day and it undercuts recent lows of the base. Look at the 52-week highs, pre-base, in the base, post-base. What does that mean? Study. What does it mean that it was a gap down reverse bar that opened on the low of the bar and reversed on volume below the 30 bar average being the black line? What does that mean? Is that a good sign? Not a good sign. Go study it. Why do you deduce that it's good or bad? So these things, they just keep happening. So Nvidia here, bullish engulfing candlestick, but it's off the 21-day EMA. Why is that important? Well, it's a region, you can see here as well. It's a region, you can see it kind of in here as well, where you're looking for large operators to step up and support the stock. Sometimes they do, sometimes they don't. But if they do, and then you get this bar here, bullish engulfing candlestick, opens on the low, engulfs the prior bar, closes really high, really strong, near the high of the session on low relative volume versus the black line there, the 30 bar average. What does that mean? To me, it means institutions are stepping up and supporting the stock exactly where I want to. Where are we from a prep standpoint? Is this the best setup I could be targeting heading into the session? How much risk am I taking? How much risk am I taking relative to the 20-day? How am I expecting this stock to move? What's the character of it? How far is Nvidia likely to then move? May it go up 20% before it closes below its 10-day? May it go up 30%? I'm going to base that on looking at prior breakouts for how the stock does move. So then I get a feel for, okay, if I'm going to target this stock, how may it move? How far may it move? Because then that feeds into my selling rules and my selling guidelines. Okay, I'm going to take 3% risk. If this stock were to trend, the last 5 breakouts that have worked, on average, not every breakout is going to work. Not every pullback that you buy is going to work. Of course not. Again, a lot of that is going to be breadth dependent as well. You got the tide with you or the tide against you. But then when you're thinking about it, and you're thinking about your selling rules, and you're thinking, okay, I'm going to use, when I look back and study this stock, I'm going to use the 10-day EMA and the 21-day EMA as a trailing stop. I've looked back the last 5 breakouts. On average, first close below the 10-day is 20%. First close below the 21-day is 25%. Okay, that's kind of a feel for it. So then if you start seeing that action play out and the stock is up 20%, 25%, and then you start to see kind of things that you would associate visually with a change of character. So supply is overpowering demand, and you're in kind of that ballpark, you've got to be aware of that. Then are you going to sell it, follow your selling rules and selling guidelines, or are you not? These are gap down reverse bars. Nearly 100 years ago for the Dow Jones on the weekly chart. GDR, 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 GDR. What does it mean when you see gap down reverse bars marking the lows of developing bases or shakeout demand temps? Is that constructive? Is it not constructive? Well, I'd associate that with accumulation, absorption of supply. Institutions create the lows of bases. They did it 100 years ago. They'll do it 100 years from now, is my belief. So this is where you just go through and you study. And you go back. But you're very aware of the price cycle. Where is the stock in the context of its own price cycle? What are the common characteristics you'd associate with phase 1 bases, phase 2 uptrends, phase 3 distributional tops, phase 4 downtrends? When you go back and you then study and you look at these stocks, how does it go from point A to point B? What do you see visually? What do you see? What do you see in terms of the price action? In terms of these moving averages? Does the stock find support there? Does it not? If it does, what type of candlestick do you see? Do you see a shakeout demand tail? Do you see a gap down reverse bar? What are your mental representations for what that means to you in terms of supply and demand, accumulation and distribution? What does it mean if the stock hits a 52-week high in the base? What does it mean if it hits a 52-week high on a gap down reverse bar that's still in the base? And the gap down reverse bar is a bullish engulfing candlestick that opens on the low of the day off the 21 and then reverses and hits a 52-week high. What does it mean to you? I know what it means to me, but what does it mean to you? And then you can start studying in terms of multiple time frame analysis as well. So you can go start looking at gap down reverse bars, so on the daily chart, and then drop it down onto the 1 hour chart. What do you tend to notice? These are really important things to be going through. So to conclude this video, hopefully it's been useful. It's been long, but hopefully it's been really useful for you and really got you thinking about your own trading process and really having clear and distinct rules for yourself. Write them down. It's a really important and useful exercise. Write them down. They may be similar to mine, they may not be similar to mine. I don't mind. But hopefully by the end of this video, you've seen the importance of actually write down your rules for yourself. How do you identify a high quality setup? Have the conversation with yourself. Imagine that you are talking to a friend. See yourself in the third person. How do you identify a high quality setup? How do you control the risk to create an asymmetric reversible trading opportunity? How do you mitigate the risk? How do you optimize the profits? What are the selling rules and selling guidelines that you are using to optimize profits, both in terms of monetary gain, but efficiency of the monetary gain? It should be really, really clear. And then also, as we started with this at the start of this video, we spoke about the type of stocks. What type of stocks are you looking to use those identify, control, mitigate, and optimize kind of rules and guidelines for yourself? What type of stocks on? Are you looking to do it on the Nvidias of the world? Or are you looking to do it on biotech stocks that are profitless, are undergoing phase 1, phase 2 trials, and have a market cap of 100 million? And the 50-day average volume is 500k. Whereas Nvidia, it's many billions. What are the type of stocks you're looking to do it on? And then think about things in terms of breadth. Okay, where am I from a breadth standpoint? Is the market generally overbought, oversold? If it's overbought and now the next swing of importance is going to be oversold, okay, what am I expecting here? It's probably going to be tougher. I'm probably going to get frustrated. I'm probably going to be angry. It's probably going to be where those kind of peak emotions are at their highest. Okay, if it's oversold and now the market that tide is coming back in and going overbought, realize that when it peaks at overbought, what are your feelings and emotions likely to be there? So as I said earlier on in the video, there's many millions of market operators, but it really is just you and the market, which really is just you. And understand where you are going to feel at different times as that tide is flowing in and flowing out, and what the leading stocks are likely to do and where you see the leadership. But if you're also really clear in terms of your identification, then your scanning is not random. You know specifically your scanning criteria because your scanning criteria is designed to find those setups. So when we really think about the efficiency of your scanning, you're not just randomly, look at this screen, do this, no, everything should be really, really clear. You should know why you're scanning. You should know the type of setups that you're trying to find in the type of stocks that you're trying to find. So there's no randomness. It's really, really detailed. So I really hope you enjoyed that video. If you made it all the way to the end, thank you very much for watching. Thank you very much for all of the support on the channel. Really do appreciate it, guys. And I very much look forward to seeing you in a future